PepsiCo just told the world its profit grew 137%, more than doubled. That's true. And it's also one of the most misleading numbers you will read this earning season because PepsiCo didn't suddenly become twice as profitable. In fact, its underlying business barely grew at all. Today, we will unpack the difference. I am Vikas. This is what changed from VYNG, Wing, where we don't chase headlines, we explain what changed. Before we begin, here is today's scorecard. Headline: Profit up 137%. Reality: Underlying business growth slowed to just 1%. And verdict: A quarter that looked spectacular but was actually mixed. Let's see why. Whenever you hear a company announce huge profit growth, your first question shouldn't be how much? It should be compared to what? Because percentage can lie, or more accurately, they can hide the context. That's exactly what happened here. Last year, during the same quarter, PepsiCo recorded almost $2 billion in impairment charges. They reduced the value of two businesses they were previously acquired: Rockstar Energy and a snack business in China. That accounting charge crushed last year's reporting profit. So, this year, they weren't competing against a normal quarter. They were comparing themselves again a quarter that had already been knocked flat. Imagine someone scoring 10 runs after scoring only 4 last year. It looks like explosive growth until you discover they were injured during last year's game. That's PepsiCo's 137%. Not a business suddenly accelerating, an accounting comparison finally returning to normal. It's less of business story and more of a math story. So let's remove that one-time accounting distortion. Now, profit growth falls to roughly 4%. Better, much more representative. But we are still not looking at the business itself because another tailwind helped this quarter: currencies. The US dollar moved in PepsiCo's favor across several international markets. That translation boosted reported results. Management didn't create that. The foreign exchange market did. It's helpful, but it isn't operational improvement. Remove that too, and the business generated roughly 1% underlying profit growth. Three numbers, one story: 137%, the headline; 4%, a cleaner picture; 1%, the business. That's the number investors should remember. 1% isn't just low, it's slowing. 2 quarters ago, underlying growth was around 11%, then 5%, now 1%. 11, 5, 1. That's no longer random, that's a trend. The engine is losing momentum, and that matters because PepsiCo is still guiding investor towards 4 to 6% profit growth for the full year. Halfway through the year, they are running closer to 3. So the second half now has to do much more of the heavy lifting. That's possible, but it's becoming harder. Now, here is where the market got something wrong. Many headlines focused on PepsiCo's North American snack business. Revenue fell about 2%. The immediate conclusion: people must be buying fewer chips. Seems logical, except that's not what happened. PepsiCo intentionally lowered prices. And why? Because over the last 2 years, snack prices had climbed enough that consumers started walking away. Some bought cheaper store brands, others simply bought less. So PepsiCo made a deliberate decision. earn slightly less today to rebuild customer loyalty for tomorrow. And it worked. Unit volumes stabilized, market share improved, customer returned, revenue dipped. Not because fewer bags left the shelf, but because each bag sold for a little less. That's a very different story. Think about your favorite neighborhood restaurant. Imagine prices rise so much that regular customers stop coming. Eventually, the owner lower prices, revenue falls temporarily, but the restaurants fills up again. That's not weakness. That's an improvement. That's an investment in future demand. Sometimes lower revenue is exactly what success looks like. What's the fascinating is that PepsiCo made the opposite decision inside its beverage business. Drinks largely held pricing, volumes softened, snacks prioritized customers, drinks prioritized price. Two businesses, one company, two completely different playbooks. Over the next few quarters, we will discover which strategy delivers stronger long term returns. That's one of the most interesting stories investors should be watching. Now, step back from North America, and another picture appears. International markets continue doing the heavy lifting. Europe, Latin America, Asia, Middle East, and Africa. Every major international division expanded. Asia alone delivered roughly 9% growth. So, today's PepsiCo is really two companies, a mature American business fighting to protect market share, and an international business still generating meaningful expansion. If you are investing in PepsiCo, you are investing in both. So, here's the question that matters next quarter. Not, will profit double again? They almost certainly won't. The real question is this: can PepsiCo begin raising price again without losing the customers it just worked so hard to win back? Because that's when a turnaround becomes sustainable. Winning customers back is step one, profiting from them again is step two. At Wing, we finish every earning review with a conviction score, not a buy recommendation, not a sell recommendation, just our assessment of how much confidence today's evidence deserves. Last quarter, PepsiCo scored 6 out of 10. Today, that moves to 4.7 out of 10. Not because the story is broken, but because the evidence became weaker. The turnaround still exists, it simply has more to prove. Three things we will be watching next quarter. The first, can PepsiCo raise prices without losing volume? Second, does North America snack growth continue improving? And third, can international markets continue carrying overall growth? Those three numbers, those three answers will tell us far more than the next profit headline. Headlines told you PepsiCo's profit doubled. They didn't. The real business grew about 1%. Growth slowed, customer returned, and the company's biggest strategic decision, cutting prices to rebuild demand. This is appearing to be working. That's the story behind the numbers. If you would like to explore every chart, source, and calculation behind today's analysis, you will find the complete research report at vyng.io. Everything is sourced directly from PepsiCo's filings because trust isn't built by confidence, it's built by transparency. I'm Vikas. This is what changed from Wing. We don't report everything, we report what changed. Clarity, not flutter.